Stop what you're doing for a second, because the silver market is flashing a signal that almost nobody on mainstream finance wants you to notice. Not next month, not sometime this quarter, right now. And if you miss it, you're going to wake up one morning and realize the price moved without you. And the reason why is going to make your jaw drop. As I'm recording this, it's Sunday, February 1st, and it's exactly 12 o'clock New York time. Before we go any further, comment what time you're watching this, because I love seeing how global this community really is. Quick thing. We've got 1,000+ members who get daily members-only videos and early access to every video on this channel, so they stay fully updated with the market. If you want to stay updated like them, consider joining. Just click the link in the description or tap the join button below. It won't take more than 30 seconds. Also, check the description after the video, because I left bonus links there, including a premium WhatsApp channel link and a channel membership join link. Now here's the headline everyone is whispering, but not many are saying out loud. China has been buying huge quantities of silver, and the local price has been trading at a premium that makes the global market look broken. And the real question isn't, did China buy? The real question is, why would they buy so aggressively? And what happens if the next step isn't just industrial demand, but a monetary move? Because there's a rumor that keeps resurfacing whenever currencies get shaky. What if they back the yuan with something real? And I'm not saying that's guaranteed. In fact, I'm going to challenge the simplistic version of that story in a minute. But what I am saying is this. When a country starts vacuuming up a strategic metal and the price in its domestic market disconnects from the rest of the world, you don't ignore that. You zoom in. You ask who's desperate, who's cornered, and who's quietly preparing for the next phase. So in this video, I'm going to break down what's happening with silver step by step. First, we'll talk about the price action and why the recent swings are not the end of the move, even though the loudest voices keep screaming top. Then we'll get into what physical tightness actually looks like, in plain English, and how you can tell when the paper market is losing control. Because there's a rumor that keeps resurfacing whenever currencies get shaky. What if they back the yuan with something real? And I'm not saying that's guaranteed. In fact, I'm going to challenge the simplistic version of that story in a minute. But what I am saying is this. When a country starts vacuuming up a strategic metal and the price in its domestic market disconnects from the rest of the world, you don't ignore that. You zoom in. You ask who's desperate, who's cornered, and who's quietly preparing for the next phase. So in this video, I'm going to break down what's happening with silver step by step. First, we'll talk about the price action and why the recent swings are not the end of the move, even though the loudest voices keep screaming top. Then we'll get into what physical tightness actually looks like, in plain English, and how you can tell when the paper market is losing control. After that, we'll connect the dots to the currency side, the yuan, the dollar, and the chessboard nobody wants retail investors thinking about. And stay with me, because near the end I'm going to tell you the one scenario that would make silver's next leg higher feel unfair. The kind of move that makes people say the market is rigged. Because it is, just not always in the direction you think. All right, let's start with what you've probably seen. Silver has been moving like it drank 3 energy drinks and decided to fight gravity. Big up days, sudden drops, then another push higher. And every time that happens, the same cycle repeats. Somebody posts a chart, slaps a dramatic caption on it, and declares the run is over. That's it. Peak. Sell before you lose everything. You've seen it. I've seen it. And the funny part is, the market doesn't care about their certainty. Here's what matters. Not the drama, but the structure. When a market tops, it doesn't just get volatile. It loses its bid. Buyers step back and rallies get sold hard. But when a market is being pulled by real-world demand, you can get volatility and still have a floor under it, because actual users and actual hoarders show up on dips like it's a clearance sale. So when you look at the last few weeks, the better question isn't, did it swing? The better question is, did it break? And for silver, the answer so far is no. Every hit has found buyers faster than the doom crowd expected, and that's the first clue. Now, the second clue is the story being pushed to explain the swings. This is where you need to keep your guard up. There's always a neat narrative offered right when emotions run hot. An index is rebalanced, a fund rolls positions, some big institution changes its weightings, and suddenly the takeaway becomes, brace yourself, because a tidal wave of selling is coming. Let me be clear. Scheduled flows can move markets short term. That's real. But what happens every time is the narrative gets weaponized. It gets used like a megaphone to scare the exact people who buy at the wrong time and sell at the wrong time. The story becomes bigger than the event. The event is a pebble. The story is a boulder thrown at your confidence. And here's the trick. When you hear a warning that sounds urgent, ask yourself, urgent for who? If the warning is everywhere, and it's aimed at retail, and it's delivered with that smug certainty, it usually isn't for your protection. It's to shape your behavior. Because when regular people buy physical silver, that metal is not sitting inside someone else's game anymore. It's not earning them a fee. It's not easily rehypothecated. It's not a number on a screen they can multiply with leverage. It's a real object that has to be sourced, moved, and delivered. And when enough people do that, the whole paper structure gets uncomfortable. So yes, you will hear about selling pressure. You will hear about inevitable corrections. And you should respect risk. But you should not let other people's fear campaign become your financial strategy. Now let's talk about the China piece, because this is where it gets interesting. Here's a detail that helps explain why this isn't just hype. Silver has a deep monetary memory in China. For centuries, it functioned as everyday money, and that cultural store of value reflex doesn't disappear just because the financial system modernized. Add to that the industrial reality. Silver is still a key conductor in high-end electronics, and it's used across energy infrastructure where performance matters. According to the latest publicly available filings and recent trade updates, silver-bearing concentrates and refined flows into China have stayed elevated, even as other imports cooled, which suggests planning, not panic. When a buyer behaves like that, they're securing continuity. That's why the premium matters. That also explains why you can see shortages show up in weird places first. Smaller bars, niche components, delivery windows, and sudden jumps in local premiums overnight. In China, the domestic silver price has been trading above the outside price by a premium that's not normal. And when you see a big premium, it's basically the market screaming, "We want the metal here, now." That premium is a magnet. It pulls supply. It creates arbitrage opportunities. It tells you there's a mismatch between what people can click buy in the West and what people are willing to pay where the metal actually needs to land. Based on recently published numbers and recent market updates, there are signs that physical demand has been intense, with local pricing repeatedly signaling tightness. And it's not just investment demand. A lot of silver demand is industrial. It's electronics, power systems, soldering, chemical applications, and yes, solar manufacturing. Silver is not a cute collectible. It's a utility metal that happens to have money history. But here's the twist most people miss. Industrial demand doesn't need to be bullish for price to explode. Industrial demand needs to be stubborn. If the world has built systems that require silver and the supply can't quickly respond, you get a squeeze dynamic. And when you add investment demand on top of that, the market can move faster than logic because the supply chain is slow and the paper market is leveraged. Now, some people hear China is buying and immediately jump to they're going to back the yuan with silver. Slow down. That's the part of the story that can turn into a fantasy if you don't think carefully. Backing a currency with a metal is not like flipping a switch. It's not just, we bought bars, now the currency is hard. Real backing requires credibility, transparency, redemption mechanisms, and a willingness to lose control over money supply. And most governments don't like losing control over money supply. They like the ability to stimulate, to bail out, to smooth, to paper over pain. Metal backing is discipline. Discipline is politically expensive. So I'm skeptical of the meme version of silver-backed yuan, not because it's impossible in theory, but because in practice it comes with trade-offs that most policymakers avoid. But here's where I'm not skeptical. A country can still use silver strategically without promising full convertibility. They can stockpile. They can encourage domestic ownership. They can use it in bilateral trade arrangements. They can use it to support confidence indirectly. They can treat it like a strategic input, the same way energy and food reserves are treated. And if they do that, the market impact can still be massive, even without a headline declaration. So instead of asking, will they back the yuan, ask this. Are they trying to reduce vulnerability to the dollar system? That's the real frame. Because the dollar system isn't just about currency. It's about settlement rails, sanctions risk, payment messaging, and the ability to freeze or block. If you're a major country and you don't like that vulnerability, you diversify. You build alternatives. You hold assets that aren't someone else's liability. And silver, historically, has been that kind of asset. It's not tied to one issuer. It's not a promise to pay. It's a thing. Now let's zoom back to the price action and do something most people won't do. Compare today's behavior to past blow-off tops without getting hypnotized by the exact same pattern. When silver peaked in past eras, it tended to surge, then collapse quickly, because the move was mostly speculative, and the market couldn't absorb the selling once the momentum broke. But in a move driven by physical tightness, the pullbacks can be sharp and still get bought, because users and long-term accumulators treat dips as supply opportunities. The key is what happens after the spike. Do we get follow-through selling that lasts, or do we see stabilization above key levels? The fact that we've seen buyers show up repeatedly suggests we're dealing with a different kind of market than a pure mania blow-off. And that doesn't mean it can't correct. It can. It will. Nothing goes straight up forever. But the corrections in structurally tight markets tend to be violent, short, and frustrating. They're designed to shake you out, then continue without you. That's why I keep telling you, don't base your decision on vibes. Base it on structure and fundamentals. So what are the fundamentals that actually matter? 1. Physical availability versus paper claims. If paper claims to silver keep expanding while deliverable supply gets tighter, you have a pressure cooker. It doesn't explode every day, it builds. And then one day, it doesn't matter how confident the commentators sound, the price gaps because the metal is needed. 2. Leasing and near-term tightness signals. When people are willing to pay extra to get metal now rather than later, that's a tell. It's not the only tell, but it's one of the cleaner ones. It means the market is putting a price on immediacy. 3. Inventories that can actually be delivered. Not total stocks, not theoretical availability, but what can be moved against obligations. When that number shrinks relative to promises, the system becomes fragile. And fragility is what drives the biggest moves, because markets don't price fragility smoothly, they price it suddenly. Now, here's the part nobody likes hearing. High prices can hurt demand. If silver gets too expensive, solar manufacturers will thrift, redesign, substitute, or delay. Electronics companies will optimize. That's real, and it's a reason to expect volatility. But there's another side. Substitution takes time. Engineering changes don't happen overnight. Supply agreements are sticky. Production lines can't just stop and restart without cost. So the demand response is delayed, which means you can get a window where price can run far ahead of what you'd consider comfortable for industry. This is why you're seeing stress in areas that rely heavily on silver. And it's why, if China's domestic market keeps paying up, global supply will be pulled toward that premium. That can tighten availability elsewhere, which then feeds back into the price. It's a loop. Now let's bring gold into the picture, because you can't really talk about monetary metals without addressing the big one. Gold has been in a long-term trend where official sector buying has been meaningful, even if the month-to-month numbers wobble. And whenever the buying slows, the narrative instantly becomes, see, it's over. But when you look at it in value terms, and you look at the broader trend of reserve diversification, it's hard to argue the underlying incentive has disappeared. Currencies are being managed aggressively. Debt levels are massive. Real purchasing power has been squeezed. And when governments and central institutions face that environment, they look for reserve assets that don't depend on someone else's promise. That's not conspiracy. That's basic incentives. So gold keeps its role. But silver is the wild card because it sits at the intersection of industry and money. It can behave like a commodity, then suddenly trade like a monetary metal when confidence cracks. And when that switch flips, the move can be dramatic because the market is smaller and the inventories are thinner relative to potential demand. Now, here's where we shift into the currency conversation, and I want you to pay attention, because this part is where most videos lose people. I'm not going to do that. I'm going to keep it simple. The dollar has strength for a reason. It's used everywhere. It's liquid. It's the default settlement currency for a ton of trade, and the financial system is built around it. But that strength is not the same as stability. You can have a currency that remains dominant and still loses purchasing power steadily. Dominance and value are not identical. So when you hear the dollar is strong, ask, strong against what? Another currency that is also being managed? Or strong in terms of what you can buy? Because most people don't live in currency pairs. They live in groceries, rent, energy, and durable goods. Now connect that to China. If China is trying to reduce reliance on the dollar system, they don't have to dethrone the dollar overnight. They just have to build optionality. They have to increase their ability to settle trade in other units, hold reserves in other forms, and reduce exposure to dollar-centric choke points. And metals fit into that strategy as a neutral reserve. So the idea that China buying silver matters isn't about a cartoonish plan to stamp silver bars with a flag and declare a new gold standard. It's about incremental moves that, over time, change flows. And flows are what move prices. Now, I promised you a cliffhanger payoff. The one scenario that could make the next leg in silver feel unfair. Here it is. If the domestic premium in China persists and global inventories that matter for delivery continue to tighten, you could see a situation where the price discovered in paper markets becomes less relevant to the physical market. And when that happens, you get discontinuities. You get gaps. You get sudden repricing because the physical market effectively forces the paper market to catch up. In normal times, paper leads and physical follows. In stress times, physical can lead and paper has to chase. And if that dynamic takes hold, the chart can move in ways that make people think something broke. Because something did break, the assumption that the paper price is the true price. Now, before you get too excited, remember, markets can stay weird and volatile for longer than you'd like, and hype can destroy you if you size wrong or you chase. So this is not a go all in speech. It's a pay attention and think clearly speech. Which brings me to the skeptical alternative perspective I want to put on the table, because I don't want you living in an echo chamber. Here's the counterpoint. China's buying could be less monetary strategy and more industrial and supply chain management. If you're a manufacturing-heavy economy and you've got massive exposure to silver inputs, you might want to secure supply. You might import concentrates and feedstock to keep refining lines running. You might be reacting to disruptions, not planning a currency revolution. And that matters, because if the buying is purely industrial stocking, it might be price sensitive. If prices go too high, they might slow purchases, which could cool premiums. That's a real possibility. So don't marry a single narrative. Watch behavior. Watch premiums. Watch delivery signals. Watch how dips are bought. And most importantly, watch whether the talk of substitution actually reduces physical tightness, or whether it's mostly talk while the metal keeps disappearing. Now, speaking of metal disappearing, let's talk about what happens when investors decide they want physical, not just exposure. When people buy a paper product, it's easy. Click. Done. No storage, no shipping, no hassle. But when people demand physical, supply chains get tested. Mints get backlogged. Dealers widen spreads. Delivery times stretch. And premiums can decouple from spot. That's another clue you're not in a normal market. And if you're thinking, okay, John, so what do I do? I'm going to answer that, but first I want you to do one thing. Decide what game you're playing. Are you trading, or are you building a position? If you're trading, you need risk controls, stop logic, and you must accept you'll be wrong sometimes. If you're building a position, you care more about accumulation zones, thesis integrity, and not getting shaken out by noise. Most people confuse the two. They say they're long-term, then they panic sell a dip like a day trader. Or they say they're trading, then they refuse to cut a loss because they believe. That mismatch is where accounts go to die. So be honest about your time horizon. Now let's shift into the oil and currency portion of this conversation, because yes, it matters here too. A lot of people still think in terms of a simple story. Oil is priced in dollars, therefore dollars are valuable. There's truth in that, but it's incomplete, because the real driver of dollar value over time is supply relative to demand for holding it, and the confidence that the system will protect purchasing power. If the supply of dollars expands faster than the desire to hold dollars, the value erodes. And that erosion pushes up the dollar price of scarce things over time. That includes energy, land, and metals. Now imagine a world where energy trade becomes more flexible in settlement, not necessarily abandoning the dollar, but adding alternatives. Even small shifts can matter at the margin, because the dollar system is huge, and margin changes move flows. If more trade can settle in other units, or through different rails, the automatic demand for dollars can weaken at the edges. That doesn't crash the dollar overnight, it just changes the slope. And metals tend to respond to slope changes. So when you see China accumulating silver, you should at least consider the bigger context. Multipolar trade settlement, diversification of reserves, and the ongoing attempt by major players to reduce dependence on a single system. And here's the cliffhanger inside that. If the dollar remains dominant, but real rates fall and liquidity ramps, you can get the worst combo for cash savers. The currency stays strong in headlines while your purchasing power bleeds. That's when people look for stores of value, not because they're greedy, but because they're tired of losing quietly. Now, I want to bring in something that doesn't get discussed enough, the ratio thinking. Instead of staring at the dollar price of silver all day, compare it to other things. Compare silver to gold. Compare silver to oil. Compare silver to broad commodities. Ratios tell you whether something is expensive or cheap relative to another scarce asset. Historically, the silver to gold ratio swings wildly, and those swings often reflect stress in the system, speculative waves, and industrial demand cycles. When silver is cheap relative to gold, it can offer torque. When silver is expensive relative to gold, it can be frothy. But ratios are not timing tools by themselves. They're context tools. And right now, what stands out is not just the ratio, but the physical tug of war, where the metal is being demanded and at what premium. Now let's get practical and answer the viewer questions, because you've been flooding me with them. The first question is basically, is this move fake? Is it just speculators and it's going to collapse? My answer, there is absolutely speculative activity. Of course there is. That's how markets move. But the presence of speculation doesn't mean the whole move is fake. The difference is whether the speculation is riding on top of real tightness or whether it's the entire foundation. If the foundation is tightness, speculation can extend the move, and then the pullbacks get bought. If the foundation is pure hype, the pullbacks become avalanches because there's no underlying bid. So the right approach isn't to label it fake or real, it's to watch the behavior on weakness. If dips keep getting absorbed and premiums stay elevated in places that actually take delivery, that's not a purely paper story. Second question. If China is buying, does that mean everyone should rush into silver? No. Rush is how people lose money. The market punishes rushing. If you want exposure, build it thoughtfully. Use scaling. Decide where your line is. Don't let a headline force you into an emotional trade. And here's a question I want you to answer in the comments. Do you think China's silver buying is mostly industrial stocking, or do you think it's part of a bigger monetary strategy? Tell me which side you lean toward and why. Third question. What if they actually do some form of backing? What happens then? If a major economy credibly links a currency to a hard asset in a way that markets trust, it can change psychology fast. And psychology is a multiplier. It can increase demand for that currency, reduce demand for other stores of value, and shift reserve behavior. But again, credibility is everything. Without clear mechanisms, it's just marketing. So I'm not betting my life on an announcement. I'm watching the trend, gradual diversification, strategic stockpiling, and physical market signals. Fourth question. What about stocks tied to silver? Miners, streaming companies, all that stuff? Those can move harder than the metal. They can also disappoint even when the metal rises because costs, energy inputs, labor, politics, and management matter. So if you're going into that space, don't treat it like a simple leverage button. It's equity risk layered on top of commodity risk. And this is where a lot of people get trapped. They buy the thing that moves fastest, then they get whipsawed and swear off the whole sector. If you don't know what you're doing, keep it simple. Now, a quick note for the community because this is important. If you're successful, share your success story in the comments so others can stay motivated. All right, now we need to talk about something that's going to sound boring but is actually a huge deal: real rates and liquidity. When the return you get on cash and bonds doesn't keep up with inflation, you're effectively paying a tax for holding safe assets. And when that happens, people start looking elsewhere. They don't do it all at once, they do it gradually. But once the shift begins, it can become self-reinforcing. That environment tends to be supportive for hard assets. Not because hard assets are magic, but because the alternative is a guaranteed slow loss. And here's the interesting connection. If policymakers respond to slowing growth or financial stress by easing, that can weaken real rates. And weaker real rates can support metals. So even if the headlines are noisy, the background conditions can still be favorable. Now, let's circle back to China and the yuan because I want to give you a clean mental model. Think of it like this. There's currency as a payment tool and currency as a store of value. Many currencies function fine as payment tools. You can buy things, pay taxes, settle transactions. But being a store of value is harder because it requires restraint and trust. If China wants the yuan to play a bigger role internationally, it needs other countries to be comfortable holding it. Comfort can come from trade relationships, from swap lines, from financial market depth, from capital controls easing, from stability, and yes, from perceived backing or reserves. Silver and gold stockpiling can contribute to that perception, even if indirectly. It's like showing you have fire extinguishers in a building. It doesn't guarantee there won't be a fire, but it changes how people feel about risk. So the silver buying story, in my mind, is less about a dramatic proclamation and more about building layers of resilience and confidence. Now, there's another fresh piece of context that matters, and it's not in most competitor scripts. The demand profile for silver has changed over the last decade. Electrification is real. Grid upgrades are real. Data centers are real. Power electronics are real. And many of those systems use silver in ways that are hard to fully substitute without performance costs. At the same time, new supply is not easy. Most silver is produced as a byproduct of other mining. That means the silver supply response is not as flexible as people assume. You can't just turn on a silver mine like a faucet. So when you get a demand shock, the market can't instantly solve it with supply. It solves it with price. And that's why you can get these episodes where the price seems to overshoot. It's the market rationing a scarce input. Now, another thing. Retail behavior in Asia can be very different than in the West. In some places, buying physical metals is a cultural habit. It's not a trade, it's savings. So if local sentiment shifts toward metals, that demand can be sticky. And if the domestic market is willing to pay up, global metal flows can change direction. That's why premiums matter so much. They're like a compass. Now, I want to address the fear that's going to pop up immediately after you watch this. What if I buy and it drops tomorrow? It can. It might. And if your plan can't survive a drop, your plan isn't a plan. It's a hope. So think in terms of tranches. Think in terms of ranges. Think in terms of what you will do if price runs and what you will do if price dips. Decide ahead of time. Don't decide in the middle of panic. And if you've been doing that well, seriously, I want to hear it. If you're successful, share your success story in the comments so others can stay motivated. Now, I'm going to give you a short reality check about paper suppression, because this topic gets people emotional. Yes, the paper market can influence price discovery. Yes, leverage exists. Yes, there are incentives to manage volatility. But not every down move is a conspiracy, and not every up move is the break. If you treat every candle like proof of a grand plan, you'll lose your ability to think. Instead, focus on what can't be faked easily: delivery stress, persistent premiums, and the behavior of physical users. Those are harder to manipulate for long because they involve real metal and real logistics. Now, you might be wondering why I'm spending time on this instead of just shouting, "To the moon!" Because the goal is not to hype you. The goal is to keep you in the game long enough to benefit if the thesis plays out. Hype gets clicks, but hype also gets people wrecked. Now, before we wrap up, I want to mention something for those of you who want deeper dives. We offer members-only videos that are produced by a separate team with more research, and those are only for premium members. If you want the extra detail, the extra charts, and the extra context, that's there through the membership link in the description. All right, let's land this plane with a simple summary and a final cliffhanger. Silver is not moving in a vacuum. It's moving in a world where supply chains are stressed, industrial usage is massive, and trust in paper promises is not what it used to be. When China's domestic market pays a big premium, that's a loud message about real demand and real urgency. Whether it's purely industrial, partly strategic, or a mix, the effect is the same. It can tighten global availability and force repricing. The Yuan question is not about a fairy tale silver standard. It's about how countries reduce dependence on a system that can be used as leverage against them. Metals are one tool in that toolbox, and when the toolbox gets used, markets respond. Now here's the final cliffhanger. The most explosive moves in silver don't happen when everyone is excited. They happen when people get bored, when volatility shakes them out, when the crowd declares it's over, and then the market rips higher because the underlying tightness never left. So watch the premiums, watch the delivery signals, watch the dips, and don't let loud voices trade your account for you. If you got value from this, drop a comment with the time you're watching and tell me the one thing you're watching most closely in silver right now. Do you think the next catalyst is industrial demand, currency strategy, or something nobody's talking about? I'll see you in the next one. And quick, important note. Everything you heard here is for education and discussion only. I'm not your financial advisor, I don't know your situation, and I'm not telling you to buy or sell anything. Do your own homework, think for yourself, and make decisions you can live with.